Hi. Let's learn about factor definition, requirements, benefits, and example. A factor is an intermediary agent that provides cash to companies by purchasing their accounts receivables. Essentially, a factor is a funding source that agrees to pay the company the value of an invoice less a discount for commission and fees. A company can improve their short-term cash needs by selling their receivables in return for an injection of cash from the factoring company. Factoring allows a business to obtain immediate capital or money based on the future income attributed to a particular amount due on an account receivable or a business invoice. Accounts receivables represent money owed to the company from its customers for sales made on credit. For accounting purposes, receivables are recorded on the balance sheet as current assets since the money is usually collected in less than 1 year. Sometimes companies can sell their receivables to a financial provider to receive cash. The funds are often released to the seller of the receivables within 24 hours. In return for paying the company cash for its accounts receivables, the factor earns a fee. The percentage of the receivable amount kept by the factor can vary, depending on the creditworthiness of the customers paying the receivables. The factor charges a higher fee if they believe there's an increased risk of taking a loss due to the customers not being able to pay the receivable amounts. The company selling its receivables gets an immediate cash injection, which can help fund its business operations or improve its working capital. Selling, all or a portion, of its accounts receivables to a factor can help prevent a company that's cash-strapped from defaulting on its loan payments with a creditor, such as a bank. A factor purchases an invoice from a company representing outstanding receivables from customers. The factor negotiates to discount the invoice and will advance a portion of the amount to the company. The factor's fees and commissions from this factoring deal amount to a certain percentage of the receivable. The factor is more concerned with the creditworthiness of the invoiced party than the company from which it has purchased the receivables. Determining whether factoring is a good investment for a company will depend on many factors, particularly the company specifics, such as the type of business and its financial condition. Factoring is generally a good investment choice for a business, as it increases liquidity, improves cash flow, is efficient, and reduces the reliance on traditional debt. Factoring allows a company to sell off its receivables at one time rather than having to wait on collecting from customers. The receivables are sold at a discount, meaning that the factoring company may pay the company with the receivables 80% or 90%, depending on the agreement, of the value of the receivables. This may be worth it to the company in order to receive the influx of cash. Depending on the type of factoring company you wish to start, your startup costs will range from $1,135 to $23,259. Here are 3 key takeaways. 1. A factor is essentially a funding source that agrees to pay a company the value of an invoice less a discount for commission and fees. 2. The terms and conditions set by a factor may vary depending on its internal practices. 3. The factor is more concerned with the creditworthiness of the invoiced party than the company from which it has purchased the receivable. Hope this would help. Thanks for watching.